Think estate planning is just about drafting a will? Not so fast. Because today, we're diving into why that's only the tip of the iceberg. What I'm about to share might completely change your perspective on how you can protect your wealth and leave a lasting legacy for the future. And stick around till the end for a tip that could save you thousands in taxes while also supporting the causes you care about most. I'm Rich Smith, and I specialize in helping business owners navigate complex financial tools to safeguard their assets and their wealth. If you're dealing with uncertainty about how to manage your wealth and protect your assets, you're definitely not alone. Today, we're breaking down what are trusts and how they can surprisingly help to serve your financial goals. Many people make the mistake of thinking trusts are just too complicated, but when you understand their benefits, it becomes clear how essential they are for your financial future. So, what exactly is a trust? Well, a trust is like a container you create to manage and protect assets. Think cash, real estate, investments, maybe even a business. When you set up a trust, you decide what goes in it, who benefits from it, and who manages it. Those people are called the trustees. Think of it as a way to safeguard and control your assets even when you're no longer around, or if for some reason you're unable to manage them yourself. Here's a real life example. Picture this: a parent setting up a fund for a child's college education. By putting it in a trust, they're not only protecting those funds, but also making sure they're distributed exactly how and when they want. In a bit, I'll explain how certain types of trusts help avoid the long, costly probate process, saving your heirs a ton of time and hassle. Now, not all trusts are the same. Two common types you'll probably hear about each come with their own benefits. The first is called a revocable trust. This type is flexible. You can change it or even dissolve it in your own lifetime. People often use it to avoid probate, meaning your heirs get assets without going through a lengthy court process. However, because you maintain control, these assets stay part of your estate, which can have tax implications. A little extra insight: revocable trusts are especially useful for people who want ongoing control of their assets, but also want a streamlined process when it comes time for these assets to go to their heirs. The second common type of trust you might hear about is an irrevocable trust. This one's more locked in. Once you put assets in, they're no longer legally yours. This type of trust can reduce estate taxes and protect assets from creditors, which is great for those passing down significant assets or a family business. Here's a quick comparison of the two. While an irrevocable trust may seem restrictive, it's a smart option if asset protection is a priority, as it can help protect against creditors and reduce your estate's taxable value. One additional insight I want to mention is that there are other specialized irrevocable trusts that can serve unique purposes. For example, there can be certain types of life insurance trusts that can be set up to cover estate taxes. There are also special needs trusts that allow you to provide for a loved one with a disability without affecting their eligibility for government assistance. Now, if you're a business owner, trusts can have unique benefits that go well beyond just personal wealth management. So, business owners, bring it in here for a moment. Setting up a trust can be a powerful way to protect your business assets and manage taxes. Instead of holding shares in your name, you can set up a trust to hold them. When you hold shares of a business in your personal name, any dividends you receive are taxed as personal income. By placing those shares into a trust, the trust becomes the legal owner of the shares. Essentially, using a trust can provide more flexibility in managing dividend income, leading to a potential tax savings. Think about it like this: if your business generates profit and pays out dividends, then they're usually taxed as personal income. But by placing shares in a trust, you have options to manage those dividends and how they're taxed, which could mean an overall savings in taxes. Trust can shield your business shares from personal liability. If you ever run into any financial trouble or you owe creditors, assets held in a trust are often protected. Also, trusts are especially useful if you plan to pass down the business to family members. Rather than going through complex transfers of ownership, you can place the business shares in a trust, and that makes the transition smoother and protects the business in the process. It's a smart way to keep your family's interests intact and ensure the business is protected from any potential personal financial issues. Now that we've covered general trusts and their advantages for business owners, let's talk about a unique type of trust that combines asset growth with charitable giving, the CLAT, also known as the Charitable Lead Annuity Trust. So, what is a CLAT? Well, a CLAT, or a Charitable Lead Annuity Trust, is a trust that benefits both a charity and your heirs, making it perfect if you want to leave a lasting legacy while also supporting a cause that's important to you. Here's how it works. You place assets into a trust over a set period, say 20 years. A fixed amount goes to a charity of your choice. After this term, any remaining assets go to your heirs. Oh, and in just a bit, I'll share an example that shows how a CLAT can grow and potentially leave more for your heirs than you initially put in. Remember, without considering the strategy we're talking about right now, you might miss out on big tax savings and miss out on the chance to support a cause that means something to you. So here's an example of how a CLAT works. Imagine you decide to fund a CLAT with $1 million. Well, doing some simple math, that means on average about $50,000 will go to your charity each year for 20 years. Over that time, the charity receives $1 million. But if the trust's investments grow, say at 10% average per year, then there might be more than $1 million left for your heirs after those 20 years. That's right. So if you're following along, you're going to want to consider growth-oriented assets for a CLAT, because those can maximize what's left for your heirs while also supporting your cause. This is an amazing financial tool, am I right? And beyond philanthropy, a CLAT offers other benefits too, especially when it comes to tax savings. Let's take a look at a CLAT in another way to break down some of the key tax benefits. Tax deduction. Funding a CLAT can give you a charitable gift tax deduction, which reduces your immediate tax bill. Also, since assets eventually go to your heirs after supporting a charity, they often avoid high estate and gift taxes. And another point to consider is capital gain savings. If you contribute appreciated assets like stocks, the trust can sell those without triggering immediate capital gains, allowing for even more growth. Overall, with a CLAT, you're supporting a charity, saving on taxes, and ultimately leaving more for your family. It's a win-win-win. To decide if a trust, or specifically a CLAT, is right for you, think about your goals. If you're looking to reduce taxes, secure a legacy for your family, and support a charity, then a CLAT would be perfect. Then again, if your focus is something different, then a traditional trust might be a better fit. Either way, it's probably a good idea to meet with an estate planner or financial advisor to explore which option fits best for you. If you are interested in exploring a CLAT to meet your financial goals, then I'll leave a link in the description of this video to help get you on the right path. Trusts are more than just tax-saving tools. They're a way to build a legacy, support causes you care about, and transfer wealth to future generations. I know trusts may sound complex on the surface, but they're actually accessible and extremely impactful. And I'd love to hear from you, so leave a comment about why you think you might need a trust, and also let me know more about what you want to see next covered on this channel.